All throughout life, you have heard the saying, money doesn't grow on trees. But we must not have been looking hard enough because free money is growing on Fidelity's trees. Fidelity once again raised their interest rates. So let's see how much money one can make from doing zero work, and let's examine how safe this money really is. Fidelity Investments is one of the largest asset managers in the world, offering high-quality platforms for investors to grow their wealth. Fidelity has been around since 1946, manages $4.5 trillion in assets, and has another $12 trillion in assets. Now, this is money they are not actually managing, but it's money people could have in their brokerage accounts. A good investor usually leaves some of their portfolio in cash, ready to deploy at the right opportunity. This core position, as Fidelity calls it, can be used for your cash dividends, could be used for deposits, or trading profits. Fidelity doesn't just keep your money sitting idly by in your account though. Generally, there's three main non-retirement accounts it can go into. We will go over each of those, but we'll start off with the one you're probably not interested in. It's called F-Cash. Yeah, that's what it's really called. Come on, did Satoshi Nakamoto come up with this name? F-Cash is just a free credit balance account, and Fidelity will give you back your money when you ask for it. It pays a really low interest rate at just 1.57%, but it's about to get much more better from here. Another core position is called SPAX, S-P-A-X-X. This is a Fidelity government money market fund. This is a taxable money market account that's going to invest in US government repurchase agreements and treasury debt. This is ideal for investors who want that steady income, they want to preserve their capital, and they want to have it liquid. The last core position we're going to be talking about is Fidelity's Treasury Money Market Fund, ticker symbol FZFXX, which is a taxable money market mutual fund investing in US Treasuries. It's again intended for the investor who wants current income and wants to preserve their capital and get liquidity in their money. We can see here what the fund consists of. SPAX is heavily invested in US government repurchase agreements, agency floating rate securities, as well as other US Treasury instruments. Both of these charge the same expense ratio of 42 basis points, but this is uninvested cash that wasn't doing anything for us anyway, so might as well get some return on our money. After all, I highly doubt that you were just going to go and invest in US Treasuries on your own, with your unused cash. What you're gonna love about these two options though is that they're now yielding over a 4% yield at the time of this recording. That's straight up juice. When I made this video 4 months ago, it was just 3.3%. Of course, Uncle Jerome and the Federal Reserve, they have raised their interest rates since then, thus these yields have went up. And that makes sense, right? Because there's now new government bonds out there that are being offered with higher interest payments. And that's what SPAX and FCFXX are investing in. What's so amazing about this is that this interest, it actually gets paid out on a monthly basis to us. So the interest compounds, meaning we're gonna be making money on top of our money, which means even more money for us. Now, a good investor is always asking questions. What are the risks? How are they making the money to offer such high yields? Well, we just explained how Fidelity is able to generate these returns by investing in US Treasuries. Fidelity also, of course, makes money by managing other people's assets. They also make money from expense ratios for their mutual funds. For even these money market accounts, we just saw that they had a 42 basis points expense ratio. But we also want to know, how safe are US Treasuries, which are the assets that SPACs and these other money market funds are investing in. Well, US Treasuries are actually considered one of the safest investments available. And the reason for this is that they are backed up by the good faith of the US government, Uncle Sam himself, or hers, or they. The US government is not going to default on its obligations. They can always just print more money. If the government defaulted on its debt, we're going to be having so many bigger problems to worry about than you getting your interest payments from Fidelity. I'm not gonna go as far as saying it's risk-free, but I'm gonna tell you, I'm gonna be sleeping real good at night with my uninvested cash sitting in these Fidelity money market accounts. Now, I know 4% still sounds like nothing when inflation is still 6.5%. I'm gonna take a guess and say it came down to like 5.5% during next week's announcement, but this is a way to get a return relatively risk-free and I don't know too many other investing options that offer this kind of upside for doing absolutely no work. Alright, let's say the Federal Reserve doesn't think they have inflation under control. They could raise interest rates even more, which means Fidelity's interest rates will climb. Maybe a couple months from now, we'll be like, wow, a 4.5% interest rate for doing absolutely nothing? Keep in mind, historically, the federal funds effective rate or interest rates, they've been much higher than they are today. Right now, it's about 4.58%, with Uncle Jerome's latest 25 basis points hike, the highest it's actually been since 2007, when it was about 5.25%. But historically, we can see from around 1970 to about the year 2000, it was pretty rare for the federal funds rate to be below 5%. And we all know a very monumental decision happened in 1971 when the US went off the gold standard, but that's a topic for another time. So this 4% yield, I certainly see this as more of a wealth preservation strategy, not necessarily a wealth accumulation one. We're probably not going to get rich with 4% returns, since the average stock market return in any given year is about 7 to 10%. However, I do think it's a great place to park my money that I'm not going to be using, since it's not collecting any interest in my checkings accounts with the big banks. And a lot of people have asked me this question. They've been asking, should they put their emergency funds into Fidelity's core positions? Now, generally 3 to 6 months worth of essential expenses should be kept liquid. Just know that Fidelity will take 1 to 3 business days to process a withdrawal. So just know that you might have to stomach going a few days without being able to get that cash right away. And the thing about emergencies is that you can't predict an emergency. Also note that interest income is generally taxed as ordinary income, which is going to be in an investor's highest income bracket. So it's not nearly as good as dividend income unless they're holding in a tax-advantaged account like a Roth. Now, this isn't financial advice or tax advice, just letting you guys know what I think of Fidelity's 2 main money market accounts. I'd love to hear what you're going to be doing with your uninvested cash. If you want to see my full 6-figure portfolio, make sure you check out the Patreon. It's a great way to help out a small-time YouTuber. Be sure to hit that like button and make sure you subscribe because I make updates like this all the time. My videos are always found in podcast form under the Collab Cash podcast name, and I am...
I'm out.